This video was made possible by Mzizi International, the official African diaspora clothing brand. Visit mzizishop.com for more information. The head of the African Development Bank has launched a scathing attack on the shadowy lending practice that critics say is handing Africa's vast mineral wealth to China and other Western powers, leaving some countries drowning in debt. Akinwumi Adesina called for an immediate end to loans offered in exchange for control over the continent's rich oil reserves and critical minerals like cobalt, essential component in smartphones and electric car batteries. These opaque deals, Adesina argues, have become a double-edged sword. While appearing to offer much-needed capital for infrastructure projects, they often lock African nations into unfair contracts and leave them beholden to foreign powers. They are just bad, Adesina bluntly stated in a recent interview, highlighting the inherent difficulty of accurately valuing resources still buried underground. How do you come with a price for a long-term contract? He questioned, emphasizing the inherent challenges in such agreement. Traditionally, these resource-backed loans have been promoted as a win-win situation. African countries gain access to financing for development projects, while leaders mitigate risk by tying repayment to future exports of valuable resources. However, these criticisms shed light on the potential pitfalls of such arrangement, particularly their lack of transparency and potential for exploitation. Before we dive into our topic today, if you haven't already, please consider subscribing to our channels and ringing the bell to be notified about all our exciting future videos. Countries like Angola, oil, and Zambia, copper, have become heavily reliant on loans from China and global Western nations secured by their resources. The problem? Falling commodity prices make debt repayment difficult, limiting funds for development outside the resource sector. This creates a vicious cycle, forcing countries to prioritize resource extraction over long-term economic diversification. The Democratic Republic of Congo, rich in cobalt, is another prime example. Recent global demands for critical minerals like cobalt is skyrocketing. The shift towards renewable energy and electric vehicles is a major driver behind this surge. This increased demand has fueled a rise in resource-backed loans, particularly for countries like the Democratic Republic of Congo, which boasts the world's largest reserves of cobalt. For context, the recent deal between China and Congo that strengthens Beijing's position in the global supply chain for electric vehicles and other products is a strong example. This agreement grants China access to Congo's vast cobalt reserves, raising concerns about resource exploitation and unequal power dynamics. Also, the recent debt expansion by Djibouti, where China holds over 45% of the country's GDP, exemplifies the challenges. Renegotiation with extended payment schedules seems more likely than forgiveness, potentially prolonging the debt burden and hindering investment in critical areas like education, healthcare, and infrastructure. This lack of investment further weakens a nation's ability to diversify its economy and escape dependence on resource extraction. Additionally, Chad's crippling financial crisis serves as a stark warning. An oil-backed loan from Glencore, a commodity trader, left the Central African nation using most of its oil proceeds to pay off its debt, hindering investment in other crucial sectors. After Chad, Angola, and the Republic of Congo faced similar challenges, prompting them to seek IMF support. The IMF, a proponent of sustainable debt management, insisted on the renegotiation of the resource-backed loans. China is a major player in resource-backed lending to Africa, but not the only one. At least 11 African countries have secured billions of dollars in loans from various sources since the 2000s, using their natural resources as collateral. Besides China's policy, banks and state-linked companies, Western commodity traders and banks like Glencore, Trafigura, and Standard Chartered have also participated in such deals, particularly oil for cash agreements with countries like Chad, Angola, and the Republic of Congo. Congo has been looking to renegotiate the infrastructure for minerals agreement it signed with China in 2008. The deal grants Chinese firms a significant stake in a joint venture for copper and cobalt in exchange for infrastructure development. However, Congo argues it has received too few benefits, prompting demands for a significant increase in China's investment commitment. This case highlights the potential for unequal bargaining power and the need for transparent agreements that ensure a fair share of benefits for resource-rich nations. While China's practices with oil, critical minerals, and bauxite have been criticized, any country can exploit a situation where negotiations are unequal and countries lack proper debt management strategies. Building capacity in these areas is crucial for African nations to avoid falling into debt traps, regardless of the lender. African nations struggling to develop their economies rely heavily on income generated from natural resources. However, these same resources are tied to loan repayments, hindering the ability to access trade loans from institutions like AfDB and the IMF that prioritize sustainable debt practices. The head of the African Development Bank highlights the uneven nature of negotiations, with lenders typically holding the upper hand and dictating terms to cash-strapped African nations. This power imbalance, coupled with the lack of transparency and the potential for corruption, creates fertile ground for exploitation. These are the reasons I say Africa should put an end to natural resource-backed loans, emphasizes Adesina, pointing to a positive initiative by the AfDB that helps countries renegotiate these loans that are asymmetric, not transparent, and wrongly priced. This initiative offers a glimmer of hope for African nations caught in the trap of unfair resource-backed loans. So what is the way forward for Africa? How can African nations improve their negotiation power to secure fairer deals for their resources? What role can institutions like the African Development Bank play in supporting transparent resource management and sustainable development strategies in Africa? Are there alternative financing models that could lessen African reliance on resource-backed loans? And finally, what steps can be taken to strengthen debt management practices in African countries? Your perspective matters. Share your insights and thoughts in the comments below. For continued updates on global affairs and diplomatic development, be sure to subscribe to the New Africa channel.